pretty much convinced we're going to make higher highs in both gold and silver this year, probably by early fall, 6,500, maybe by, I don't know, September, October, $150 silver during that same time frame. If we come out of this correction and we start to go vertical and we slice right through 6,500, but we do it very quickly. Let's say we get a bottom next week, and within 4 weeks we are already at 6,500, then yeah, we're back in the parabolic phase, and we've got 3 months left. We're probably going to maybe 8,000, 10,000 long shot. And if that's the case, yeah, we're done. Bull market's over, and you got to sell your physical and get out and look for something else to invest in. Banks are on the hook for 33 million ounces of physical silver, and so they took a chance of trying to crash the market, and they succeeded, and it caught a lot of people at that top. So say silver goes up 400%, and miners and GDX goes up 375%. Well, silver outperformed, but you still made a lot of money even in GDX. So yeah, it's not that big a deal. You're going to make money in both.
If we look at the precious metal sector, Gary, so we have seen gold and silver sort of being stuck in a range for a while now, and some people see that as a bullish. So we're building a base, which is the launch pad for the next move. But also some people look at 2011 and they're trying to find some similarities to that. So how are you assessing that market at this moment?
I don't think we're in 2011 again. I think we are building a base. Yeah, it is taking longer than I initially expected. When I saw that gold to silver ratio crashing, that the only other times that's happened in the past has been when we are heading into like at least a cyclical bull market top like 2011, or a major bull market, secular bull market top in 1980. So that had me thinking that we were starting the bubble phase of the gold bull market, the bull market having started in 2001 or 99. We double bottom. Take your pick as to what you think the bottom was. So we're in the bull market's very mature, and with silver really starting to go parabolic after breaking through that $50 barrier, and the gold and silver ratio crashing, it looked to me like we were starting that final bubble phase. Now, I was expecting a correction, so not out of the question that we would have that correction in January. I think there was some suppression along with that, because the banks were going to be on the hook for delivering, I think it was over 33 million ounces of physical silver, and they certainly did not want to have to deliver that at $120 an ounce. So
markets look calm, yet the gold to silver ratio is flashing signals that historically appeared near major turning points. Gary Savage notes the last comparable ratio collapses occurred around 1980 and 2011. Periods most investors remember only after the move was over. The real question is why a supposedly free market keeps encountering sudden pressure precisely when physical delivery obligations rise. For long-term savers, the danger isn't volatility itself. It's misreading a consolidation phase as the end of the trend. Next, Gary Savage exposes why this prolonged correction may actually be extending the bull market rather than ending it.
But anyway, we were due for some kind of correction anyway. But because I was expecting we were in that final bubble phase, I thought it would be over somewhat quickly. And I turned out to be wrong on that. This has turned out to be a severe correction, and it's eating up a lot of weeks, which there's a silver lining to that, in that I think we are not in the parabolic phase right now. I think we've gone back to the wall of worry phase. And the longer you can remain in the wall of worry, the higher ultimately price should go in the end. So if we had just had, a quick move down, maybe scary move, that first move down, and then pretty quickly right back to making new highs, we would have remained in the parabolic stage of the bull market, and our ultimate top was probably going to be maybe 8,000, 10,000 would be maybe a long shot in that scenario. But it looks to me like we've corrected hard enough and long enough that we're back in the wall of worry stage. And if we can stay in that phase for a couple more years, then I think it puts our ultimate high for the bull market at probably 10,000, maybe even as high as 15 or even 20,000. So, a silver lining that this has taken longer than I expected, in that I think we're back in the wall of worry phase, and that puts our ultimate target higher.
Right. So would that mean, Gary, that, it would be completely normal to see gold and silver stay in this range for longer, even let's say until the end of this year or even beyond that?
The longer a correction overstays its welcome, the more dangerous it becomes for investors relying on emotion instead of cycles. According to Gary Savage, what looked like a brief shakeout has evolved into a deeper wall of worry phase that may ultimately support higher prices later. Historically, major bull markets exhaust participants through time more than price, which is why most people quit before the biggest advances arrive. For wealth preservation, patience often becomes the asset that outperforms the portfolio itself. Next, Gary Savage reveals why timing, not price alone, could determine how high this cycle ultimately reaches.
I don't think I think we're just about done. I'm kind of watching what's happening here. It looks to me like um, the shorts or the banks, it looks like they're going to try and manufacture an undercut of that March pivot. Uh, I don't know if they're going to be able to do it in silver. Silver's a little stronger, but it looks like they're going to try in gold. And if they can do that, it'll create a capitulation event. Retail traders will give up, hedge funds will give up, they'll all panic sell. It'll make a lower low, panic sell, and that'll allow the banks. These are manufactured events. That'll allow the banks to cover their shorts into that panic. There'll be a lot of volume when everybody panic sells. The banks will be able to cover their shorts at a big profit and then get long, and it will also be the fuel for the next leg up. And as I said, if we can stay in that wall of worry phase, then instead of going to 8 or 10,000 during this next intermediate rally, I would think a more likely target would be maybe we get to 63 or 6,500, 7,000 long shot, and then we have another one of these scary corrections, and then we repeat the process, and then the next leg up maybe goes a little above 7,000, and another correction. And the longer we can keep stair stepping up like that, the further the bull market's going to ultimately go. So I think we're pretty close, maybe even just days away. And I think the shorts are going to try and undercut that March low in gold.
When panic selling suddenly appears after weeks of stability, the first question should be who benefits from the fear. What Gary Savage is highlighting is the possibility that a final breakdown could create exactly the liquidity large players need to reposition. The overlooked detail is that capitulation events often look bearish at the moment they become most useful to institutional traders. For everyday investors, reacting emotionally to engineered volatility can mean transferring wealth directly to better positioned participants. Next, Gary Savage exposes the positioning dynamic that could turn maximum pessimism into fuel for the next advance.
So, if that happens, don't get too depressed. Understand what's happening. It's a manufactured move to allow the banks to cover their shorts into that volume panic selling event, and that should be the end of the cycle. We're too far along in the 8-year cycle, I think, to waste 2 years going sideways. I think we got to be over here pretty soon, within a few days, maybe even early to mid next week, and then I think we start the next leg up. I'm pretty sure, pretty much convinced we're going to make higher highs in both gold and silver this year, probably by early fall. So 6,500 maybe by, I don't know, September, October at the latest. $150 silver during that same time frame, and then we get another correction.
That's very interesting. Can I ask you this question, Gary? So, what would make you change your thesis to say that, okay, so this bull market is likely finished, or that we are actually in this final parabolic run? So, what would be some of the indicators that you will look at that will tell you, okay, this does not look good?
So if we come out of this correction and we start to go vertical and we slice right through 7,000, well, let's just say we slice through 6,500, but we do it very quickly. So let's just hypothetical situation or um, thought experiment here. Let's say we get a bottom next week, and within 4 weeks we are already at 6,500. Then yeah, we're back in the parabolic phase, and we've got, I don't know, 2, 3 months left. We're probably going to maybe 8,000, 10,000 long shot.
Wall Street says markets are efficient, yet major turning points somehow arrive right after waves of forced selling. Gary Savage's argument suggests that if a sharp rally follows a final washout, the market may be signaling exhaustion of sellers rather than creation of new risk. The contradiction is that public narratives often celebrate stability, while capital flows reward volatility. For investors protecting purchasing power, recognizing when sentiment and positioning diverge can matter more than any headline forecast. Next, Gary Savage unravels the specific signal that would convince him the bull market is entering its final parabolic stage.
You'll see that gold silver ratio crash down to 30, maybe even as low as 20 to 1. And if that's the case, yeah, we're done. The bull market's over, and you got to sell your physical and get out and look for something else to invest in.
Okay, and let's look at another scenario where we don't get the parabolic move, but price maybe continuously slides lower. What indicators, what price targets would make you think that, okay, so that peak was it, and we're going lower from here?
Oh, we would probably have to go all the way back down to 2000. If at that point I would say, yeah, that was the top. There really wasn't much of a parabolic move. I would have to somehow rationalize a 45-year breakout base in silver only produced a 2.5 month rally, and it was only just a little over 100%. The breakout rally in semis was, I want to say, 16 years, and it's produced a 900% gain over the last 4 or 5 years, 6 years, something like that. These breakouts from really long bases, they don't generally only produce a 2.5 year rally. So it just seems very unlikely to me that this was a final top. I think we got a lot further to go.
Right. And you guys still expect silver to outperform gold and to be, the best performing asset out of these two?
I do. I think we'll probably go under 30 to 1 on the gold silver ratio at the top.
If a 45-year breakout fails after barely a few years, one of the most important market signals in modern history would be broken. This is where Gary Savage's thesis shifts from price forecasting to probability analysis. Long duration bases rarely produce short-lived advances, which raises an uncomfortable question. Why are so many investors already acting as if the cycle is finished? For wealth preservation, selling too early can be just as damaging as holding too long when secular trends are still unfolding. Next, Gary Savage exposes the ratio signal he believes will matter more than the gold price itself.
We might even get down as low as 20 to 1 or even 15 to 1, but I think I would be starting to sell some of my physical gold and silver once we hit 30 to 1, and some more at 25 to 1, and probably the rest of it at 20 to 1, and not worry too much if we were to get to 15 to 1.
Right. And how would you approach even the gold bull market? So let's say gold goes higher, and we don't know if it goes parabolic or if it uses the staircase approach. How would you, what would be your strategy on taking profits, maybe certain levels? How would you approach the next move?
Um, well, spotting tops is not easy. Generally, what happens is you get out a little too early, and then the market keeps going up, and if it goes up far enough, you get FOMO, and you go back in, and then you do that. Maybe you get away with it once, but once you start taking profits trying to dodge the top, then you start to get nervous. So every time you go back in, your fingers, hovering over the trigger because you're afraid you're going to get caught. And usually what happens is you get caught, and uh, and you get caught in that intermediate correction. The best defense for tricky markets, and the metals market is pretty tricky, is physical, and don't worry about the intermediate corrections. So you buy your physical, you set and you hold, and when you see that gold to silver ratio going below 30 to 1, then you start thinking about selling.
Most investors obsess over the exact top, yet that obsession is often what prevents them from capturing the bulk of a bull market. Gary Savage notes that the real challenge isn't identifying value, but resisting the emotional cycle of fear, profit-taking, and FOMO. Wall Street benefits when investors constantly trade because every decision creates friction, fees, and mistakes. For long-term holders, having a predefined exit framework can matter far more than trying to predict the final explosive move. Next, Gary Savage reveals why one overlooked ratio may outperform every headline, forecast, and analyst target.
So I bought most of my gold and silver, my gold at about 1,800, my silver between 22 and $25. I've held it all, for the last, whatever it is, 4 or 5 years. I weathered the 8-year cycle low in 2022. Never even occurred to me to panic and sell my physical. And I've had to weather every single intermediate correction along the way, and a lot of them were scary. This one's been scary, but I never sold. And that physical physical gold and silver that I bought years ago and have just held on to has made me millions so far, and I expect it's going to make a lot more millions. So that's the that's the part that will get you to the end of the bull market. Is you should have most of your um, investment capital in physical, and just buy it and forget about it, and just watch the gold silver um, ratio. When it gets, like I said, when it gets down below 30 to 1, then you can start thinking about selling your physical. The trading part is, um, it's more difficult because the markets are erratic, and then things like, what we saw in January, out of the blue, we get, what was going to happen anyway, but I think a natural correction would have been more like a rounded top, and you'd have had plenty of time to get out with most of your profits intact. But that wasn't allowed to happen. Like I said, the banks were on the hook for $33 million, or 33 million ounces of physical silver. And so they took a chance of trying to crash the market, and they succeeded. And it caught a lot of people at that top. So
The biggest gains in precious metals often come from surviving corrections that convince everyone else the story is over. According to Gary Savage, holding through multiple frightening drawdowns has been more profitable than trying to trade every twist in the market. The pattern investors overlook is that sharp declines frequently occur when confidence is highest and positioning is most crowded. For retirement-focused savers, missing a handful of major advances can do more damage than enduring temporary volatility. Next, Gary Savage walks through the institutional behavior that may explain why sudden corrections arrive when optimism peaks.
So trading is just a lot more difficult. You tend to overtrade these erratic, volatile markets, but you can make some good money on the trading accounts. But it's easy to give it back if you get caught during one of these intermediate corrections, which everybody will get caught at least once. Nobody's going to be perfect on these.
Yes, thank you for sharing that, Gary. If we look at MINS stocks, if you look at the actual health of some of these producers, right, in gold and silver, they look really good. We've seen some financial reports. The margins are really high. Companies feel very comfortable. It looks like some M&A activity is slowly kicking up. So you've already mentioned that you prefer the physical, but with that being said, do you feel that the whole sector looks interesting and potentially attractive?
Yeah, I think well, as soon as the correction in gold is over, and gold and silver start going back up again, the miners are going to follow them. I don't generally try and pick individual mining stocks. If I want to trade miners, I would just buy an ETF, GDX or GDXJ or SIL, something like that. It's been my opinion that I think physical silver will probably outperform like GDX or GDXJ over the long haul, say between now and the end of the bull market. I think you'll make more in physical silver than in the mining ETFs, but they're both going to do good. So by more, maybe I'll just pick some numbers.
Mining margins are expanding, acquisition activity is increasing, and yet mainstream coverage remains focused on short-term price swings. What Gary Savage is highlighting is a disconnect between improving fundamentals and investor attention. Institutions often start positioning when balance sheets strengthen, long before retail recognizes the shift. For portfolio protection, the key issue isn't whether miners or silver win by a small margin. It's whether you're positioned before capital begins chasing the sector again. Next, Gary Savage exposes why institutional interest in miners may be sending a stronger signal than gold's daily price action.
Say silver goes up 400% and miners and GDX goes up 375%. Well, silver outperformed, but you still made a lot of money even in GDX. So it's not that big a deal. You're going to make money in both.
Yes, and you don't find platinum and palladium as attractive as gold and silver, no?
Well, I don't really follow those markets. I'm pretty sure we'll make plenty of money in gold and silver, so I'm not going to drift off into markets, small markets that I'm not terribly familiar with. But platinum does generally seem to follow gold. So if gold's going up, I suppose platinum would as well.
Investors constantly search for the next overlooked metal while ignoring the assets already attracting the strongest conviction. Gary Savage's argument suggests that focus itself can be an advantage when a macro trend is still developing. The financial media often pushes diversification for its own sake, yet institutional capital typically concentrates where risk-adjusted opportunities are clearest. For wealth preservation, chasing every emerging narrative can dilute returns more effectively than any market correction.